Good morning and welcome to the GRC International Group PLC investor presentation. That's a recorded presentation. Investors will be in listen-only mode. Questions are encouraged. It can be submitted at any time via the Q&A tab situated on the right-hand corner of the screen. Click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. The company review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Alan Calder, CEO. Good morning to you, sir.
Hi, I'm Alan Calder. I'm the Chief Executive of GRC International, and welcome to this presentation of our FY23 results. I'm joined today by Chris Hartshorn, our Group Finance Director, and during this presentation we're going to be giving a brief summary of some of the highlights of FY23. Chris will talk you through an update of the finances, and then we'll spend a bit of time looking at the future and how we see GRC going forward and some of the issues that we're addressing in as we progress into an exciting next few years. That kind of leads into the investment case, and when you access this webinar, there are a selection of appendices with more detailed information in them, which you may find useful, but which we're not planning to cover through this webinar. As Paul said, please, if you have questions during the webinar, do stick them in through the Q&A function on your screen, and we'll deal with them when we come to the end of our planned presentation. So, turning to FY23, it was a year in which we rebuilt revenue growth around a combination of cybersecurity and privacy. We recovered gross margins to in excess of 60%. We built contracted and recurring revenue to in excess of 70% of total revenue, and we now consistently generated positive EBITDA. So those were our four main objectives that we set ourselves post the GDPR boom and crash, and we've now achieved all four of them. And I just want to give you a little bit of context to why we set those as objectives and why the achievement is important. Leading up to our IPO, which was back in February 2018, IT Governance was a one-stop shop supplier of products and services for cybersecurity and privacy. We had a single strong brand, the IT Governance brand, which was primarily a UK brand, and we had wide-scale GDPR focus. We'd grown revenue very rapidly from £4.8 million in FY16 to 15.7 million in FY18, and we grew that on the back of the advantage we were able to take of the GDPR opportunity. So data protection revenue grew from 4% of our revenue in FY16 to 57% of the revenue in FY18. But recurring revenue, when we started on this journey back in FY16, was only 2.5% of total revenue. We had highly immature processes and systems across the businesses, might expect from a relatively small people-focused business, and the IPO enabled us to acquire DQM GRC in autumn of 2018. So that's kind of leading up to the IPO. Post-IPO, the GDPR market went on expanding, and then although we'd expected after the law came into force in May 2018 that there would be a bit of a pause and then the market would continue growth come the autumn of 2018. That's exactly what didn't happen. GDPR demand dropped very, very dramatically, and over the course of the next few years, that was followed on by all of the turmoil around Brexit, about how Brexit was going to happen or not happen, how COVID-19 would impact companies and individuals, and the ravages of the epidemic, not just in the UK, across the world, and then the Russian invasion of Ukraine, the global monetary tightening of the last 6 to 12 months, an ongoing series of critical issues in the global socio-economic geopolitical environment. In that market, our data protection revenue dropped from 57% of revenue to 31% by FY20 and has been rebuilt now to 37% in FY22. We've grown cybersecurity and privacy revenue in tandem. And you can see how the GDPR boom has enabled us to scale up and stay, in spite of some of those vagaries, stay significantly bigger organization than we were prior to GDPR. We obviously had to right-size the cost base very substantially. We restructured into 3 revenue divisions, so revenue divisions rather than organizational divisions. We've built out additional specialist brands in our publishing company, in Vigilance Software, in GRC e-learning. We've built on DQM, which we acquired, as I said, in autumn 2018, and we've built GRC Law into a significant non-SRA regulated provider of legal services, primarily around GDPR. So that's the overview of what happened between financial year 16 and 23. And it's kind of worth then looking at that in figures, because it's fairly noticeable how the trends that I'm talking about impact our figures. You can see revenue going from pre-IPO, so that's FY17, from 6.8 million to 15.7 million. That's a huge scaling up in a very short space of time. We then, with Brexit turmoil, post-GDPR, managed to keep revenue still above 14 million. COVID pandemic had a real impact on us being able to deliver services. Our revenue came down to just under 12 million, and we've then been rebuilding that. So 14.7 million in FY23, in spite of the chaos in the UK, where, if you remember, there were some 2 or 3 UK governments without an election in the space of just several months. The Queen died, there was new king. All of that hiatus in autumn of 2022, of course, created yet another set of challenges. Our gross margin went from 61% pre-IPO, dropped. We've rebuilt that now to 61% in FY23. From EBIT positive, we were EBIT positive in 16, 17 and 18. We then had a number of years of negative EBIT. And frankly, in FY20, we would have been, if COVID hadn't kicked in in the last couple of months of that financial year, we would have been we would have been EBITDA positive. We certainly were in that last 6 months. Could have continued through into the pandemic year, but pandemic hammered revenue. But we've rebuilt again out of that. So £1 million worth of EBIT in FY22. And in spite of building out our quality of services in FY23, another year of positive EBIT. Average FTEs went up hugely, had to come down post GDPR. And with the shift in the business from being primarily a people business delivering consultancy training with a little bit of products, we've become a business primarily delivering services, technology enabled or technology services, with a very significant element of recurring and contracted revenue. So we've gone from 5% in FY17 up to 73% of our revenue is contracted and recurring, so much greater visibility around revenue. And the privacy cyber revenue split has kind of evened out. It was 29% privacy back in FY17. It's 37% privacy in FY23. So the balance in the business is still quite clearly there. And the reason I talk about the geopolitical events is, of course, historically boards tend to hold back on spending around cybersecurity. Whenever something looks as though it might be going wrong in the economy, they think of it as a discretionary spend. And that's an indicator of the extent to which historically boards haven't properly understood their responsibilities in respect of cybersecurity and data protection. But as we'll explain shortly, quite a lot of that is going to change pretty dramatically over the course of the next few years. So just very briefly looking at the more operational aspects of FY23, nothing very dramatic, nothing very flowery. It's been a year of focusing on simply doing things better, improving across the state of the business. So our annualized recurring revenue up 31% now to 10.9 million. That's a very substantial jump in ARR. We've improved the average value of our software as a service customers, of whom we have about 300. Average values up about 5%. We've rebuilt and built out the training course portfolio. We've added new courses. We've added digital badging, which enables people who pass examinations on one of our courses to boast about it on social media, which is good for marketing. And we saw in Q4 a 17% increase on the prior year in training course delegates. Completely revamped our ISO 27001 product portfolio. The new standard, the 2022 version of the standard, there are some 60,000 companies around the world who have to transition to the new standard by the 1st of November 2025. And so as we're one of the leading providers of ISO 27001 services around the world, a fully up-to-date suite of services, products and services is essential. We've improved our Net Promoter Score to 48. 50 is considered as excellent, and that's been a steady year-on-year increase. That's customer feedback. And we got a Trust Pilot scoring going, and our average running back to autumn of last year and through on a regular basis is now 4.5. And that's particularly focused on our e-commerce activity, and 4.5 is technically excellent. Most importantly, and we'll look at this again in a bit more detail, through last year we combined the individual modules that we sold as software as a service into a single platform called Cyber Comply, and that's both ISO 27001 and GDPR modules. So it is possible for clients to buy a single integrated platform that enables them to tackle 27001 and GDPR, to which we've added a cyber incident response module, which ties in with the other capabilities on the platform. And given the frequency of cyber incidents, is quite an important step in terms of the business. Looking very briefly at the divisional performance, so software as a service, e-commerce and services, professional services are now just under 50% of the revenue. When we came to market, there was something well over 75%. And we saw increase in revenue in both professional services and, more importantly, in software as a service. Our software as a service division is where the highest margins in the business are, and where we continue to invest in building out our products and capabilities. E-commerce flat, quite a good result considering the hiatus of autumn last year, the severe ructions around the government, the sudden shift in interest rates, the fear around the Liz Truss government, all of that led to a big pause in people spending, doing discretionary expenditure, which hit our e-commerce revenue. So coming out flat across the year is a pretty solid result. So that's probably quite a good place for me to halt and hand you over to Chris Hartshaw, our Financial Director, to talk you through the finances. At the end of that, I'm going to turn to and we'll talk through the way we see the future. Chris, over to you.
Thanks, Alan. Good morning, everybody. So the slide on the screen at the moment simply sets out the financial highlights for FY23 as taken directly from the RNS statement that we released a couple of weeks ago. So revenue up for the year 6% to 14.7 million. That's up from 13.9 million in the prior year. Within that revenue figure, international revenue was up 3% to 3.1 million. Our international revenue predominantly comes through our IT Governance USA and IT Governance Europe businesses, and we see those markets as significant growth markets in the future. Our SaaS division revenue up 11%. As Alan's mentioned, it's pleasing to see the group's highest gross margin division generating the fastest level of growth within the group. Our recurring and contracted revenue up 30% to 10.7 million, up from 8.2 million in the prior year. It's been a significant drive of ours for the last couple of years, as we've talked about, to improve recurring and contracted revenue, both to drive overall growth and also to improve visibility of future performance. We're now in a position where 73% of our revenue for the period came from recurring or SaaS-style contracts. Gross margin year on year up 2 percentage points from 59% in FY22 to 61% this year. That overall improvement is driven by two things. Firstly, it's the growth in the SaaS and recurring revenue style contracts, which are naturally higher margin for us. And it's also a reflection of some operational improvements in terms of developing our automation in the e-commerce division, and also some improvements in consultant utilization rates in the services division. EBITDA for the year of 0.3 million compared to 1 million in FY22. We'll talk a little bit more about EBITDA through the year in a slide or two's time. Cash balance, positive cash balance at the year end of 0.1 million. And again, there's another slide where we'll talk a little bit more about the cash movement as we'll come on to shortly. So the story for EBITDA for the year really went as follows. Our H1 performance saw good levels of revenue growth, solid, strong EBITDA performance, pretty much bang on exactly where we expected to be and where we wanted to be in line with our budgets. As we came into Q3, we invested in line with our plans into some additional headcount, some specific lead generation and marketing campaigns that we expected to fuel higher levels of growth through the rest of H2. And H2 traditionally is our stronger performance period. Right around exactly that time, we saw, as Alan's mentioned, the upheaval of the UK government. We saw Liz Truss's brief time in power and the impact of the mini budget. And we also saw the impact of the Queen dying and additional bank holidays and all of those sorts of things. All of those things had an impact on the wider economy. And what we saw was a real slowdown in momentum in 2 of our 3 divisions. In e-commerce, we saw a slowdown in that division because it holds the majority of our public training course products. That type of spend is very easy for finance directors to turn off when times are uncertain. It's the type of spend that's often seen as discretional, and it's very difficult to get the budget for that kind of spend when the economy is going through a bumpy period. In our services division, what we also saw through Q3 was not so much a slowdown in interest, but a significant lengthening of our sales cycle. Whereas historically, we would expect to see salespeople start talking to a customer and maybe 3 or 4 weeks later sign a contract with that customer. What we saw in Q3 was negotiations going on sometimes 11 or 12 weeks. And it wasn't the fact that people didn't want to get on with projects. It was much more a case of people needing additional levels of sign-off, additional levels of budget authorization and things like that through that difficult time. Into Q4, we then saw momentum pick up much, much strongly as people started to spend again, and we started to see the results of some of the marketing campaigns and lead generation campaigns that we'd invested into in Q3. So a very, very strong performance through our Q4, very, very EBITDA positive through Q4, and that momentum has then continued into Q1 of this year. The slide on the screen at the moment sets out some of the divisional performance, both in terms of revenue and gross margin. I'm not proposing to go through each of the numbers on the screen, but of course, the detail is there in the pack for anybody who wants to download the pack either through this platform, or the pack is also available on our company website, and you can go down to that and view it through there. The one point that probably is worth touching on in a little bit more detail is the gross margin improvement across the year. So whilst the gross margin has improved on a company-wide perspective by 2 percentage points through the year, what we saw was actually month-on-month gradual improvements through H1, a dip through Q3 as we'd expect with that slowdown in momentum, but then very, very strong gross margin performance coming back through Q4. And through Q4, we were consistently seeing gross margin up into 64-65%, and we've continued to see that through the early part of this year and expect to see that continue into the future. As we've said, with our international revenue, the majority of it is serviced through local entities. Whilst that's not a particularly important point at the moment, as those seen as significant growth areas, we do expect that to provide a natural FX hedge, mitigating that risk going forward as those two companies grow. The next slide sets out the cash movement for the year. And although there is a cash outflow of £2 million for the year, that's very, very different to cash burn. It's worth highlighting that in January 2022, we raised just short of £3 million, or we raised £3 million, received just short of that net of fees. And we raised that funding for 2 very specific purposes. The first of those purposes was to invest into capital expenditure, predominantly around software development, where we've built out our cyber comply platform. And the second of those reasons we raised funds was to deal with HMRC liabilities that we'd built up through the COVID pandemic. We deployed those funds as per the plan and as we expected to do so. And with just over £1 million going out to HMRC, dealing with those historic debts and a capital expenditure balance of £1.6 million during the year, you can see that by stripping out those two very specific pieces of expenditure, the underlying working capital movement for the rest of the business was cash generative. So pleasing to then finish the year, given all that, with a positive cash balance at the year end, and also with significant headroom still available on our banking facilities. There is in the pack, further back in the appendices, a more detailed slide setting out the rest of the balance sheet. Again, not proposing to go through it for this presentation. The key movements for our balance sheet really are the capital expenditure, the reduction in HMRC debt that was built up through the pandemic, and the cash movement that relates to those two things. So once we've understood those points and that movement, there isn't an awful lot else to touch on with the rest of the detail in the balance sheet. So that, therefore, seems like a sensible place to hand back to Alan for him to talk to us a little bit more about forward strategy and current trading update.
Chris, thank you. And indeed, turning to forward strategy, on screen you can see 4 randomly selected data breaches that have occurred over the course of the last few months. And I can predict with some certainty that in the next quarter, there will be a number more significant data breaches around the world, and I can predict with equal certainty that there will be a number of organizations who will be fined for breaching GDPR either in the UK or the EU, or breaching a data protection law somewhere else in the world. Those things I can predict with not just quite a lot of certainty, with absolute racing certainty. And the reason that I say that is because the nature of the environment is continuing to change in favor of cyber criminals. So the attack surface is continuing to expand. The combination of remote or hybrid working, and that's whether people have to go into the office 3 days or not at all, or but remote and hybrid working, the migration of so many companies to cloud and cloud-based services with all the advantages that those bring, the digitization agenda proceeding at pace across the world, and now the Internet of Things, where not only driverless motor cars, but all the rest of the digitally connected devices that there are mean that the number of possible vulnerabilities is growing exponentially. The number of opportunities for cyber criminals to break into digital networks and access information and do nefarious things is growing significantly. And therefore, not surprisingly, the threat horizon is more and more crowded. Serious organized crime. Once upon a time, serious organized crime would have a little bit of cyber crime activity. Now there is serious organized criminal gangs whose only activity is digital crime. But serious organized crime is a major driver of cyber crime. Of course, nation states, whether for the purposes of disruptive warfare or for pursuing a political agenda, or simply and much more likely in pursuit of hard cash. So North Korea, Iran, Russia, all of them locked out of global markets. They need hard cash. Cybercrime is a very good way of getting at it. They've got some very sophisticated, advanced cyber criminal gangs operating obviously slightly below the radar. And of course, then there are competitors, and your competitors are as likely to want to break into your systems and steal information and disrupt your business as will anybody else. And the nature of cybercrime has become so sophisticated now that ransomware, the most prolific and effective form of cyber attack, has become an ecosystem in which there is a well-developed delivery chain. You have people who specialize in creating ransomware, others who specialize in deploying it, others who specialize in gaining access to networks, and others who specialize in extracting the ransom, and then others who do other things with the data once you've got it. It's become a very professional, albeit completely non-contractual operation. It's very costly. So a report out from Reuters earlier on this month said that in Germany, cybercrime will cost 206 billion euros in 2023, in calendar 2023. And you think about that multiplied by 150 odd significant economies around the world. That's a huge global economy. 52% of German organizations say that cyber attacks will threaten their existence in 2022. Not just be quite difficult or quite dangerous or cost them money, but threaten their existence. And that's a recognition that cybercrime is an existential issue for organizations, not just one of cost and disruption. So why do they go on happening? Well, most companies continue to think that cybercrime can be dealt with by deploying more technology. And of course, that is simply the wrong answer. Technology is the wrong answer to the wrong question. The issue that, and if technology worked, we wouldn't have cybercrime. You know, if you look at the breaches and you say to yourself, well, everybody spent millions and millions and millions on firewalls and all sorts of things with splendid acronyms. Why do we still have cybercrime? It's because technology is not the answer. Human beings are the favorite route into a network for cyber criminals, because human beings are capable of being socially engineered. They're inquisitive. They make mistakes. They make errors, and of course, they need to access information. The internet's only useful if people can use it to share and access and send one another information, which means that the opportunity for cyber criminals to take advantage of that is huge. Helped now, of course, by AI and by deep fakes, which make the whole business of social engineering even more effective. So what does an organization do? Well, the ICO has spotted that mostly organizations don't do anything they should do. So in the last 5 years, since UK GDPR hit the press, became law, one of the most common data breaches reported to the ICO year in, year out is misuse of the CC, the carbon copy field on an email. So instead of using blind carbon copy to send out a list, send information to a list of people who should not be known to everybody else on the list, people regularly post it into the CC list. This is just a failure of governance, a failure of management to manage and teach people how to do their jobs properly. And the ICO's kind of reached the view that this is such an obvious thing for management to deal with that it's likely to become a standard area for fines. So what do you do? The answer to the question isn't more technology. It isn't for the board to turn to the head of IT and say, go buy more technology to deal with these issues, because that's not going to solve the problem. The answer is the board has to put in place a GRC-driven, governance, risk management, and compliance-driven cyber defense in-depth strategy. And a cyber defense in-depth strategy is one which recognizes that you're going to be breached. Attackers will get through multiple layers of defense, and so what you have to do is have the competence and capability to respond to it. You have to be able to soak up attacks. You have to have everything in from basic staff awareness training all the way through to effective business continuity plans, which respond to incident response, which respond to staff who are trained, which are operated by staff who themselves are properly trained. So, and remembering that privacy and cybersecurity are simply different sides of the same coin, the reality for organizations is what you've got to do is build cyber defense in depth, board-driven cyber defense in depth. Now, we see that governments and regulators are agreeing with us. A board-led GRC strategy is now mandatory in a number of areas. So for EU GDPR and UK GDPR, which is where this started, the lawmakers recognized that management's given half a chance would defer expenditure, said, fine, if you do that, you face the possibility of a fine up to 4% of global turnover, 17 million pounds. And the effectiveness of that strategy has led to a proliferation in regulations which carry serious punishment with them. The Europrivacy itself, the need for organizations to demonstrate their compliance has triggered the creation of a seal, the Europrivacy seal. An organization can pass a set of audits which include ISO 27001 as the demonstration of cybersecurity, and have a seal which proves to their customers that they are GDPR compliant. SWIFT, 11,000 organizations around the world use the SWIFT system to move money. It's been successfully hacked by, Korea, North Korea and others. SWIFT has brought in a set of requirements for organizations to create a board-led GRC-driven strategy with self-attestation around compliance, PCI around payment cards has been there for a number of years and is becoming more and more enforced. Across Europe, the Digital Operations Resilience Act, organizations have to comply with that by January 2025. It applies to some 28,000 financial sector companies who now have to be able to demonstrate that the board has put in place a risk management strategy, that there is some competence around cybersecurity, that the risk management strategy deals with protecting data, it has a business continuity component to it, and it recognizes the threats posed very specifically by suppliers and in particular by managed service providers. Mandatory requirements in DORA. Most interestingly, in the United States, the SEC, the Security and Exchange Commission, some 5 weeks or so ago, voted in favor of a set of regulations which mandate all US listed entities to report cyber incidents to the SEC. They've been able to sweep it under the carpet for some time. But more importantly, not only do they have to report, but they now have to, in their annual declarations, identify that they have a risk management strategy that deals specifically with cybersecurity, that the board is aware of what's going on, that management is properly empowered to deal with it. In other words, a governance, risk management and compliance strategy. And in the UK government is planning to launch a cyber governance code of practice in 2024, which has at its heart the idea of a board-led risk management strategy, competence, staff awareness training, all of the components that make up a cyber resilience defense in-depth framework for organizations. So what that means is cybersecurity is becoming a matter of compliance, not of choice, with clear penalties for negligence, not just maybe your share price will be affected and you can't afford to spend money, but cybersecurity is moving down the track that health and safety went so many years ago, to a point where taking appropriate steps is a mandatory requirement with significant punishments for organizations, and we're beginning to see potentially for directors as well. And this is, we think, a significant inflection point. And it's significant because the market is huge. The current vended market is about 1/10 the size of the total potential market. And this is a piece of work done by McKinsey, breaking the cybersecurity market down into a number of segments. And we obviously in GRC International focus on data protection, on the GRC and the security consulting segments, but we also deal with the GRC components across the whole of the market. So all of those segments, there is an element of policy, of procedure, of competence, and we deliver services into all of those areas. So from our point of view, the potential of the market is huge. The addressable market is very, very big indeed. Now, there's something of a challenge for organizations in this huge market growing this quickly with this increasing array of regulatory requirements, is how on earth do you deal with that? And traditionally, you'd employ an expert. There's a bit of a problem with that because there's a global shortage of about 2.7 million people. The job gap, the workforce gap, is about 2.7 million cybersecurity and data protection experts. So hiring somebody is not something you can do unless you've got a lot of money, and then the chances are they will be lured away by even more money somewhere else. And this is going to get to be more and more dramatic. And so, your traditional organization, mid-sized corporate organization with a couple of people, 2, 3, 4 people in its compliance and quality assurance team, they not only have to comply with the kinds of laws I'm talking about, but the average now is about 6 different frameworks and regulations. 70% of organizations recognize that's what they've got to do. They might be a customer-driven or a regionally driven or a sector-driven legal framework or a regulatory framework. And once you've complied, that's not enough. You've got to keep on updating it, as ISO 27001 demonstrates. It gets updated, standards get updated to recognize changes in the attack surface and the threat horizon. 77% of organizations have to transition to updated frameworks in the near future. So it's a real challenge for organizations, particularly if, like some 60% or 70% of organizations, you think you can manage compliance on a spreadsheet. You can't. And so the reality, the change in the market creates a real opportunity for vendors that combine a wide portfolio of GRC services that can help you address the wide range of issues that you've got, supported by genuine deep subject matter expertise who can say, this is not how you implement ISO 27001, you're wasting money, this is the right way to go about doing it. And that's supported by a best practice GRC management and compliance platform. And that is exactly what you get in GRC International. So we have the widest range of services. We call this the cyber reg tech market. It's a market driven by regulations. It's based on technology. And of course, it's cyber focused. So the cyber reg tech market, in which an organization like us with a very broad and very comprehensive range of services covering training, staff awareness, tools, consultancy, subject matter expertise, the kind of stuff that helps you do what you need to do, supported by a platform like Cyber Comply, which enables you to go on accessing the best-in-class services that you need with documents that are updated as and when they need to be, all of which enables you to manage compliance on a consistent and robust basis. We think this GRC RegTech market is in its infancy. We're not the only people who've spotted that a platform-based approach to cybersecurity is the only way that organizations will be able to survive. So we think that the cyber RegTech market is over what Gartner called the chasm. We're in the early adopter phase of the adoption curve. And if you think about the hardware and software, the anti-malware, firewall, SIEM, and so on, hardware and software stuff as being about the middle of the early majority, we've got an awful long way to go ahead of us as organizations recognize that what they need is a platform which enables them to manage cybersecurity in a way that's consistent, producing a dashboard for senior management and for the board, which tells them exactly what the state of their cybersecurity and privacy compliance is at any time across the organization. So against that set of objectives, against that market, our short-term objectives obviously are to continue investing in the Cyber Comply platform. We've got a very clear multi-year roadmap adding functionality and capability to a platform which already supports something like 25 different frameworks and standards from around the world. We're migrating some of our separate platforms into Cyber Comply so that it becomes a comprehensive platform that enables organizations to automate internal audit, automate external audit, manage supplier audits, all of those kind of things in a very automated and joined up way. We'll continue focusing on product market fit across the portfolio, particularly in new regulatory areas like DORA, Europrivacy, the SEC, and in supplying the US Defense Industrial Base, the CMMC framework. All of them frameworks organizations have to comply with, all of them dependent on a platform for robustness, all of them needing to be supported by people who know how to do these things. We'll continue improving client acquisition, driving up average customer value, driving up customer lifetime value, and we already have a relationship between customer CAC, customer acquisition cost, which runs about £420, which is about average for a professional services business, but customer lifetime value is over £9,000. So from a revenue point of view, and when you look at our gross margin, 61%, the contribution in revenue terms to EBIT is very significant from our ongoing business model, our ability to acquire clients and develop them over the long term. And we expect the investment in our software as a service business to continue driving exactly that. So we're obviously going to broaden international growth. Those are our short-term objectives. And before I turn to the investment case, which is worth going through, we in current trading, Q1, we had positive EBIT, so negative a year ago. This year, positive EBIT for Q1 to the end of August, cumulative billings ahead of the prior years. So we can say today we're trading in line with market expectations. So that's the trading update. Let me just turn to the investment case, because I think there is a very clear case to be made for investing in GRC and through GRC in this market. It's a very fast-growing international market. It's fragmented. There are lots and lots and lots of small businesses who can do only one thing or do two things. Building a platform on the scale and with the capability and robustness of something like cyber comply is a multi-year exercise. Supporting that with genuine subject matter expertise is a rare capability for anybody, and providing that service into a market where the opportunities in a digitally transformed, cloud-based hybrid working environment with more and more vulnerabilities is driving more and more organizations to recognize that complying with the law is not only something they have to do, it's also quite a smart thing to do. It saves them from going out of business. It saves them from all of the significant costs that there are in breaches. So GRC, we are an established, respected, market-leading 20-year-old IT governance brand. We have an experienced management team. We have strength in depth across all of our subsidiaries and divisions. We have a very broad customer base because our model encourages customers to come to us. We deal with customers across all sectors and of all sizes, which means that we have quite a lot of resilience in our business. While we might get the odd bit of fluctuation, the reality is that there is significant resilience in the operation, and we are dominant in our positioning in SEO terms. It's important that we remain dominant because that's how people find us. Our defense in depth offering is unique. It's built around the logic of cyber defense in depth. We have the broadest range of products and services with all of the cross and upselling opportunities that come with those, and they will be driven increasingly through the cyber comply platform. And as you can guess, a business like this, we have very substantial intellectual property in our software, in our content, in our brands, in our know-how, and around all of those capabilities, we've built multiple national and international accreditations, the independent verification of the quality and independence of our service that enables customers to recognize that dealing with us is kind of like a sensible thing to be doing. And again, while we have that there are the economic headwinds, we're not a cyclical business like white goods or retail are. We have significant revenue growth opportunities, and we are growing. The growth in our recurring and contracted revenue, which is already 73% of total revenue, gross margin at over 60%. There is further growth there. And the way in which we've invested in our software as a service and e-commerce divisions and their infrastructure means there is inherent operational gearing that means that we are highly scalable into the fast-growing market that we see available for us. Significant customer retention and revenue visibility come as a result of our SaaS platforms, and we are managing to fund our investment out of our own operations. So pre-investment, we are a cash positive organization. So a number of good reasons to invest in GRC as a share. And that brings us to the end, ladies and gentlemen, of the presentation for today. So I'd like to thank you all for having joined us. And I'll hand you back to our organizer.
Fantastic. That's great, Alan. Chris, thank you very much indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions just using the Q&A tab on the right-hand corner of your screen. To click on Q&A, type in a question and press send. Just while the team take a few moments to review those questions submitted today, I'd like to remind you that recording the presentation along with a copy of the slides and the published Q&A can be accessed via your investor dashboard. Alan, Chris, as you can see, we've had a number of questions submitted throughout today's presentation. I should please ask you just to start at the top, read out the question where appropriate to do so, and give your response, and I'll pick up from you at the end. Thank you.
Great. Thank you. So, question, great to see recurring revenue and margin increasing. Are we at a point now where any further revenue customers are incremental to the bottom line? Yes, is my answer. Chris, do you want to comment further on that?
Yeah, well, other than to agree, I mean, yes, we are. It's worth just highlighting that we will continue, obviously, to invest in software development, to continue to build out those products and services further in order to make them more attractive and to grow revenue base more significantly in the coming years. But yes, from an individual company perspective, the SaaS platforms within the business that we currently sell, additional customers to those SaaS platforms are acquired at pure profit.
Great, thank you. The next question is, the US is a substantial market. How do you maximize? Is it through channel partners? And the answer is, that's one of the ways we maximize in the US. We established a business in the US a couple of years ago. It's a standalone independent subsidiary with its own team. It's growing pretty solidly, and we are growing in the traditional way. We have a website. We sell training, we sell books, documents, all of those kind of things that people find and they buy from us. We build on those relationships, but we've also just launched our channel operation. We have an existing well-established channel business in the UK, which takes our services to the end market through managed service providers. We've just in the last few months launched that in both the US and the EU, so we expect to see channel revenues overall making a growing contribution to our performance. But the US is a very big long-term market. It's one in which regulation, while up till now primarily driven by litigation, the shift in the SEC regulations, or the arrival of the SEC regulations combined with CMMC and the complexities of demonstrating compliance there, we think brings a huge opportunity and a huge growth opportunity for us as a business in the US. The next question, Alan, as the largest shareholder, what can you say around the share price performance? As the largest shareholder, I can tell you I think the share price performance is terrible. I think the current share price is hugely undervalues the business. The fact that I am a member, I am both a significant shareholder and a member of the concert party with the directors, means that I'm unable to buy more shares in the business. I would, if I could, at this price. I would be insane not to, but I can't. I can't do that without apparently buying the whole company, and that's not something which is within my skills. I would certainly be buying. So I think the share price is a huge opportunity for anybody who understands and sees the potential in the market to buy shares in a company that's addressing that market opportunity. The next question: How do you accelerate from here? What's needed? Well, we accelerate from here by building out our cyber comply model, by building the cyber defense in-depth messaging, and we have a pretty revolutionary approach to pricing. We're shifting our cyber comply pricing. We're soft launching that in November. We are then, through the amalgamation of a number of internal activities, we'll very quickly have a very much more substantial platform, which will be driving out into the market. So we can, on our own capability, scale the business from where we are. We would, if we could raise investment, which at the current share price is very difficult to do sensibly, we would accelerate our investment in platforms and in the speed with which we can deploy to the market. But we're an EBITDA positive business. We intend to stay that way, and so we'll continue focusing on driving growth into and through our cyber comply platform as fast as we possibly can.
Alan, thank you. I think you've addressed all the questions that we've had through. And of course, any further questions that do come through, you will have the ability to review those and we can publish responses where appropriate to do so. Alan, perhaps just before redirecting investors to provide their feedback, which is particularly important to you and the team, I could just ask you just for a few closing comments.
Thank you. Yes, indeed. So the opportunities for GRC over the course of the next 3 to 4 years are significant globally, both in the UK and in the EU and the US, and also in Australasia, the Asia Pacific Rim. Cybersecurity knows no bounds. Cyber criminals operate indiscriminately around the world. Data protection is a huge and growing issue. So there's a very big opportunity, a hugely addressable market. The future is unquestionably one in which regulation technology and the cyber reg tech market and our shift, which we've been driving over the course of the last 5 years from a essentially services business to a very highly profitable cyber reg tech business, will continue and will continue driving benefits for shareholders as we take forward our attack of the opportunities which there are. Thank you all for being with us today.
That's fantastic. Alan, Chris, thanks for updating investors today. Can I please ask investors not to close this session? It should be automatically redirected to provide your feedback, and all the team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure is greatly valued by the company. On behalf of the management team of GRC International Group PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you, and good morning to you all.